Ladies and gentlemen, good day, and welcome to the SH Kelkar and Company Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal the operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mit Shah from CDR India. Thank you, and over to you, sir.
Thank you, Darwin. Good afternoon, everyone, and thank you for joining us on SH Kelkar and Company Limited's Q3 and 9M FY24 earnings conference call. We have with us Mr. Kelkar, Full-Time Director and Group CEO, and Mr. Rohit Saraugi, EVP and Group CFO of the company. We will begin the call with a brief opening remarks from management, following which we will open the forum for an interactive Q&A session. Before we begin, I'd like to point out that certain statements made in today's call could be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I'd like to invite Mr. Kelkar to make his opening remarks. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on this earnings call today. I hope you have gone through our results documents, which were uploaded to the exchanges earlier. You can see we have delivered a healthy year-on-year, quarter-on-quarter revenue growth this quarter, maintaining the momentum we started in the first half of the year. The performance was driven by increased contributions from new accounts, a revival of demand from mid-sized and smaller accounts, especially new e-commerce and startup companies, and enhanced performance in the rest of the world markets. While the base in the corresponding quarter last year was low, our results do stand out given the overall softness in the FMCG industry. Furthermore, our core Europe segment has reported all-round positive results with healthy revenue growth and strong gross and EBITDA margins. We have also sustained our margin performance during the quarter, assisted by various initiatives, and remain on track to report over 16% EBITDA margins for the full year. Regarding segmental performance within our core fragrance vertical, along with the strengthening of our position in the well-established Indian market, we have also achieved growth in various new export markets. The team is actively implementing a strategy to better penetrate existing and new markets, particularly focusing on Southeast Asia, Africa, the United States, and other markets. We are confident that this performance is sustainable going forward. Our flavors segment also delivered an encouraging performance during the quarter. Moving to a key business development, we are extremely pleased to announce that after over 2 years of dedicated efforts by our R&D, perfumers, marketing, and other teams, we have secured multiple order wins from the global MNC player. The F&F industry is well known for its high entry barriers, particularly in establishing new accounts. This success is a testament to our team's perseverance and innovation capabilities and marks a significant breakthrough in the penetrating the tightly held global accounts. Although the business contribution from these initial orders is modest, we are fully committed to strengthening this partnership further. We consider this as a beginning of a relationship which we aim to develop into a long-term partnership with substantial growth potential over the next 3 to 5 years. In conclusion, our transformative turnaround initiatives over the past 12-15 months have laid the foundation for our performance this year. Our recent success with the MNC order highlights our proven R&D capabilities and our ability to meet global standards of the F&F industry. Furthermore, our preparedness in terms of capacity ensures that we can scale up operations efficiently to meet the increasing demand and capitalize on any such business opportunity. On that note, I would now request the moderator to open the forum for any questions or suggestions you may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bharat Gupta from Fair Value Capital. Please go ahead.
Hi, Kedar. Good afternoon. Congratulations for a good set of results. My first question pertains to the volume growth. What can you quantify what would have been the volume growth across our regions, across both the segments, particularly flavors and fragrance during the quarter?
So the price growth in this quarter was quite small, probably very low, 1 or 2%. So most of the growth is in volume terms.
And that is across both the segments?
That is across the segments.
Okay. Secondly, coming on the RFQ bit, so we have received the order from MNC, and I think we were expecting a run rate of 100 crores per annum for 3 years. So the order will match the kind of a run rate we were expecting?
So I think the quantum of the expected quantum is still there. The ramp up which we were expecting in 3 years is probably going to take longer with some program delays on changeover and so on and so forth from the client side. So the program will be longer term, but the quantum is still the same.
The quantum of 300 odd crores cumulative, that will remain the same, but the timeline has extended.
Sure. I think the ramp up of the business is kind of delayed by 12 to 14 months. So that is kind of the delay in the program itself. But beyond that, all the other parameters remain the same.
All right. And when we are expecting the orders to get translated into the revenue side?
So we have received the first orders for new projects, and these will ramp up over the next 1 year to various geographies and different brands. So our first orders for a couple of wins have started. Not significant in terms of revenue at the moment, but we expect by second half next year, the full rollout of these products will happen in the market.
On the expansion side, so we are doing some sort of a CapEx in the Indonesian region. So is it primarily directed towards the RFQ, or it is just we are exploring the Indonesian market?
So we have been in the Indonesia, Southeast Asia market for many years. We have built a sizable business in the market, well over $10 million. And with the Indonesia investment, we will establish our own manufacturing facility for fragrances in Indonesia and near Jakarta. I am pleased to announce that the facility is almost ready, and we will be commissioning the facility in this quarter.
Sir, if I look at the order wins which we have been awarded by the MNCs, so do you believe that the trend for going localization across, so that has been the key trend which the industry itself is witnessing? And if yes, so are we participating in any tenders being floated by any other MNCs in India or in the overseas market?
I think we are not actively participating with any other tender. We have more than enough opportunity for growth and projects on our development team. So we're not actively chasing other MNCs at this point. Once we have this project running for 2-3 years, we will build the capability. We will take it to other clients as the strategy may be.
Right. And the order wins currently corresponds to the deliverables out there in the domestic market and the Indonesian market?
No, these are global wins. They will start in different regions.
Okay. Sir, secondly, if I'm allowed, so I have a question with respect to the Italian arm, the CFF. So I think it's been running at the optimum utilization levels, and we aren't exploring any opportunity for doing CapEx. So, don't you expect the volumes to remain stagnant if we operate at the current levels? And the margin improvement which we have seen across the European business, so is it primarily driven by the operating leverage, or there is some colors with respect to the change in the product mix as well?
So a bit of product mix as well as operational efficiency. We have been able to streamline the operations to get kind of pull out more production volume from the same facility. Various steps have been taken to optimize the production between the two facilities in Netherlands and Italy. So this has helped us to increase the volume of production without any significant capex. We expect that there may be a European-wide capex in development and manufacturing sometime 18 months from now.
So we'll be exploring the CapEx after 18 odd months. Currently, can we grow in double digits in the European market?
Yes, we have been able to make efficiency gains in our production to allow us to grow, and that will push, if we look at a 10 to 12% CAGR growth, it will push our capability to allow us to service the client and the current customer base into 2025 to 26, somewhere between in that years.
And the margins which we have maintained, so are they sustainable?
Yes, these are the historical margins. We had actually lost some of the margin in a couple of years ago, and we are now back to the historical levels.
So consolidated 16% is what you can guide for the years to come, probably for FY25 and FY26. These are the kind of margins we can build in the projections.
I think they are quite reasonable number. 16% EBITDA level on sales is a good trend line. We are looking to expand that and do better than 16%, but I think 16% is where we are at the moment.
Okay. And so the last question, if I may allow, it pertains to the US subsidiary. So what are the thought process for forming out the subsidiary, and are we looking out for any inorganic opportunity as well? Or it's primarily directed towards exploring further opportunities for the RFQ side from the existing or newer client base?
Yeah, so both the subsidiaries are targeted towards organic growth. We will put in people and development and marketing resources to tap into new markets and or support our current business depending on the requirements. So the subsidiaries, the United States subsidiaries where we expect to grow that market as a new market area for us. And then within Europe, we will strengthen our development resources and production footprint to allow us to cover more markets within Europe.
Can you tell us about the market overall with respect to USA? How big is the market and what kind of opportunity size it presents for us?
So we are just starting. So we are basically starting from zero in the fragrance and flavor side of the business. The US market is one of the largest single market in the world, and it is almost 35 to 36% of the global fragrance and flavor market, which translates to between $7 and $8 billion of fragrance and flavor opportunity in the market. Having said that, we are just starting, so we are very modest. We will look at working with the small and regional clients to build a small base and keep further developing the market. In every market, new entrants normally will start with the regional and small players, and then it takes many years before proper established facilities and reputation to penetrate the larger clients.
Right. That's it from my side. Thank you so much for answering the question.
Thank you. The next question is from the line of Jainam Gilani from Swan Investments. Please go ahead.
Hi, sir. Congratulations for a great set of numbers. So, sir, I wanted to know what was the contribution from a new products in this quarter?
What do you mean that? So our sales mix in this quarter, roughly 2 to 3% has been from new products.
Okay. And so what are the steps that we've taken to improve our efficiency?
So we have, various steps, but the main or the kind of significant steps are in the European operations. We have combined between Holland Aromatics and CFF, so Italy and Netherlands. So they work as one combined operation that helps us with the raw material efficiency and also the production planning efficiency. So we are able to get more production between the two facilities combined than each of the facilities as a standalone facility.
Okay. And so what is our capex plan for this year and the next year?
So I think this year we have undertaken the large capex on the Indonesia factory, which should be ready by next financial year, full year. We don't expect any large capex on production side in the coming year. We will continue to invest in kind of incremental capex and capex on the product development teams and infrastructure for product development, which will be continuous ramping up. As we work with more and more larger and more number of diverse projects, we will need to put the infrastructure and people of diverse backgrounds in different geographical locations. So we will continue to grow the footprint as far as the product development teams are concerned. This is expected to maybe even double or triple in the next 3 to 4 years. For the production facilities, we have enough capacity for Asia. Europe, as I mentioned, somewhere in 2026, 25 and 26, we will need to reinvest or add additional manufacturing capacity. That's it.
So would you be able to quantify this figure, please?
I don't have a exact number for the same with me, but in terms of our normal 20 crore is our maintenance capex. We'll probably add another 20 crores in terms of the capex on new facilities or different locations.
Okay. So what are our plans for debt reduction in FY25 and 26?
So we are committed to operations efficiently. I think at this point the cash flow generated has been largely blocked into going back into capex and inventory. And the inventory, as we talked about, we expanded our inventory base given the available raw material situation. And we will start to reduce that as we go through the year. Starting this quarter, we are already on a inventory reduction plan.
So just one last question from my side. So is it safe to assume that our base business will grow by 10 to 12% and the new orders will contribute meaningfully from H2 FY25?
Yes.
Okay. Thank you, sir. That's it from my side.
Thank you. The next question is from the line of Zakir Nasir, from an individual investor. Please go ahead.
Hi, Mr. Kedar. I think, first of all, congratulations to you and your team for a wonderful set of numbers and getting SS Kelkar to a position where it should have been. Sir, one very interesting point you made was the demand from e-commerce and startup companies. Could you just elaborate on this point? Would you think that the push, at least in India markets, will come from these segments, sir? And of course, the other point of growth and EBITDA margins has been answered. You said that you would be maintaining that 10 to 12% and the current EBITDA margins. Thank you, sir, and best wishes.
Thank you. No, I think the e-commerce and small side of the business has been growing faster than in the previous years. As you know, we witnessed a couple of market disturbances to the pandemic and the earlier GST demonetization, which adversely affected the momentum in the new brands and smaller accounts. Alluded to almost a 2-3% of market share decline in the past. On the last year base, we have now finally consolidated, and the business across all the categories is growing. We are doing market plus growth in all sectors of the business in fragrance and flavors. The important thing is that the market dynamics, the larger FMCG players are showing smaller volume growth this quarter. I think this is a current trend, but I think on a longer term, the growth will be across the board.
I may ask us, what about the major players? I mean, how would you foresee competition from them, and are they becoming more active in India?
The major players have set up their own subsidiaries in 1990s, and they're all very active, and they're well over 60% of the market share in all of them combined. So they're very much here. They're all active for decades now, and it is part of the competitive landscape.
Thank you, sir. Best wishes to you and the team. Thank you.
Thank you.
Thank you. The next question is from the line of Nihar Shah from Crown Capital. Please go ahead.
Hello, good afternoon, sir. I joined in the call late, but I heard
sorry to interrupt, but the line for you is not very clear. I request you to please move to an area with better network.
No,
sir, it's not clear at the moment. Nihar, may we request you to please rejoin the queue after you establish a better connection?
Yeah.
Thank you.
Yeah. Sure.
We will move to the next question, which will be from the line of Amarnath Bhakat from Ministry of Finance. Please go ahead.
Yeah, hi. It's Amarnath from Ministry of Finance of Oman. Just to see clarity, just now you said that the major market share is gained by this multinational player who are already established offices in India. Could you please help us, what would be approximately your market share at least in the Indian side?
Our market share in the Indian fragrance business is roughly around 20%.
So all the MNCs put together, they have a market share of 60%, and your alone market share in India is around 20%.
That's correct. When you say all, there are 4 or 5.
Yeah, there's 4 or 5 MNCs who already established their presence in India since last 10-15 years. So they all put together have 60%, and you alone having 20% in Indian market. Is it right?
That's correct. On the fragrance side.
And okay, so then if I ask you, then what is your exactly the competitive advantage compared to those global MNC players who are there in India? And what is exactly coming to your advantage to get that 20% market share, especially when the market is crowded by the global MNCs?
So I think the question is, there are a lot of facets to this question. We have different projects, different strengths and weaknesses, every other fragrance and flavor company. So we operate on our strengths, understanding of the local conditions, local markets. We have well over 100 years of legacy on R&D and innovation. So we have platforms of different product types which are successful in the market. So every company develops products. It's a kind of a continuous innovation industry. So we need to continue to invest in innovation, continue to improve our product offering. So to that extent, the market share is built over many years of continuous innovation and customer connect. And that's our USP. We continue to work on it and continue to bring new generation of products to the market.
So if I extend this discussion a little, sir, so in the last few years, have you able to gain market share? And if yes, then how the trajectory look like? I'm only talking about the Indian market.
So I think if you look at I would go a little bit further than 3 years, 5 years. We actually lost market share as a result of the demonetization and GST twin effects and pandemic. In these three sort of events, the smaller customers and the kind of the smaller the businesses, the more difficulty they had at these times. And we shrunk our small business to the SMEs and smaller accounts in this period. I estimate roughly 1 or 2% market share loss to the larger global F&F companies. Since last year and this year, we have started to recover. We are growing faster than the general average industry. So I would imagine we are now picking up again some market share.
And sir, what would be your capacity utilization, especially at the Indian plant at the moment?
So on the fragrance and flavor capacity, we are less than 50% capacity utilization. So there is adequate capacity for next decade plus.
So shall we assume, so less than 50% means it's very low utilization level at the moment. So shall we assume that as this, I can say the low period of this FMCG company, which most of the FMCG company are saying that their volume growth were muted because of rural demand in India was not picked up, and however their projections in the future, including HUL, Dabur, Patanjali, all are saying that future volume growth is quite visible, at least in a higher single-digit growth they can achieve. So if we assume that they are growing at that speed, so your growth would be faster than that. And if your capacity utilization is less than 50% at the moment, then as you increase your capacity utilization, you will get a significant operating leverage benefit. Is this assumption right?
Yes, that assumption is right. I just wanted to kind of highlight that the capacity utilization is going to be incremental, additional 3-4% capacity will get utilized year on year. So we don't see that the capacity utilization will be anywhere near full capacity anytime soon. So there is definitely operating leverage, but unlike chemical industry where it's a single product, we have many number of products. So it's a incremental process. It's not a sudden change.
Then how would be this ROE and ROC picture, sir? Because your presentation is not very clear on that. What is the ROE and ROC at that present level?
Rohit, you may want to answer the exact numbers.
Stands at 12.5% and ROE around 11%.
Sorry?
Hello?
Yeah, can't hear you properly.
Yeah, the ROC stand at 13% and annualized, and the ROE is around 11%.
So, what's the plan, sir, to improve? Because 13 and 11% is not that great, unless because normally then the standard talked about 15% minimum ROE, ROC, especially the kind of business you have and your improvement in the gross margin, capturing the market share which you lost, increasing the volume growth. So when can we expect the improvement in this ROE and ROCA parameters?
I think we will quickly see that coming in as the growth continues in the coming year. The major part of the kind of capital employed is in the inventory, and we have strategically done that in the last 18 months when the inflation and subsequent now the reduction in prices. So we are at a kind of high inventory status at the moment, and we will pull out inventory from days sales of inventory as we go through the year. Our target is to,
if I may ask,
20% of ROC.
please continue, sir. What is the target? Sorry?
Upwards of 20% of ROC.
And within what time, sir?
I think if we pull out, if you kind of do a math of 12% growth and 7-8% decline in inventory, we will be there in 4 to 5 quarters.
4 to 5 quarters, we can reach from 12% of ROC, which is currently, to 20% of ROC.
That's correct.
That's a good improvement. Sir, if I may allow last one question. Your cash conversion to your profitability is quite enriching, and previously you have used all this internal cash and the debt for the future expansion, either domestically or internationally. But as you just said a few minutes back, that you do not have any major CapEx, future CapEx lined up. So how would be your capital allocation policy would be? Are we planning to use this incremental cash coming from the business to repay the debt first, or it will be used for paying dividends, or how it would be your capital allocation policy going forward?
So we have a capital allocation or a profit distribution policy where we distribute between 30 and 40% of the cash profit or profit earned in the year. We've been consistently following that as a dividend and or share buyback from time to time. As regards the cash flow that we will generate, I think our last large outlay is been done in the Indonesia project now. We do not expect any inorganic growth. And just to kind of give you color of the debt and current debt, and we are around the 500 mark in terms of current debt. And we have spent something like 450 crores of monies to acquire 2 companies or 3 companies in the European continent. So most of the debt that is on the balance sheet today is basically as a result of 100% acquisitions of 2 companies. We are now fully completed those acquisitions in the last 4 years. So there is no large outlay on the balance sheet for on the company in terms of commitments made for any inorganic acquisition. So we expect the cash flows to bring down the debt.
These 2 companies which you acquired, sir, how they are performing now? Are they at par with your existing business?
Yes, they are at par. They are actually better than the historical business in India, given that they are operating in Europe, which has a better margin, kind of better margin environment than emerging markets.
so their ROC is better than you at the moment?
Yes, there is a different business model that is followed there, which is on very much just-in-time inventory with 1 or 2 months of inventory, and they follow different business model. Within the group, because we have a high inventory model, we are also holding the inventory for the emergency for the rest of the group.
Okay. Thank you very much, sir, for patiently answering all the questions, and best of luck.
Thank you very much.
Thank you. The next question is from the line of Venkat from Mirabilis Investment Trust. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. This is Ashutosh from Mirabilis. So a couple of questions. First is on the cost side. Sequentially, we have seen a decent pickup in employee costs as well as other expenses. So is there anything particular that you can highlight here? And second one is on the global RFQ. So our earlier assessment based on your calls was that the gross margin profile would be slightly lower than company average, while EBITDA will be similar. So does that still stand, or has it seen some change? So these are the two questions.
Yeah. So on the EBITDA question, it stands as it was earlier. You can quickly rephrase the first question. You were looking at the
employee cost. So I'll take that, Kedar.
Yeah.
Employee cost, there is an increase sequentially, which is primarily led by new hires, which we have included in our team to enhance our capability, and true up of the performance pay bonus, which is linked to our performance. And on the other overheads, there is an increase which is in line with the sales. And if you look at the sales numbers, the percentage to sales are maintained.
Okay, sir. Thank you. Second is on the global RFQ. So, the gross margin profile, our earlier assessment was that that will be lower than the company average, while EBITDA will be similar. So with all the delays that we have seen, has there been some change in the supply arrangements or product profile that you were to do? So does that assessment still stand, or has that seen some change?
No, that assessment still stands. There is no change in that.
And lastly, on the global ingredients part, so again, that has also seen some pickup with all the efforts that you have been doing. So this quarter we have done 11.5 crores of revenue. So where do you see the run rate going forward for the global ingredients?
I think we have alluded earlier that on the global ingredient side, we are looking at a full backward integration. Pleased to announce that our backward integration program has commenced actual full commercial production since December. We are already seeing the global ingredient sales and margins better than last year with our cost reduction program and efficiency on the product. We will further see improvements in this based on our backward integration, further reduction of input cost. So I think the global ingredient, which is been sort of in negative territory last year, we look at making it a positive EBITDA contributor in the quarters to come.
Okay, so thank you. That would be all. Thanks.
Thank you. The next question is from the line of Kunal Tokas from Fair Value Capital. Please go ahead.
Hello, am I audible?
Yes, you're audible.
Yes.
Most of my questions have been answered, sir. I just had two left. You talked about your deck, but I think I missed it. What is the deck on our books right now?
526 crores.
526 crores.
Yeah.
Okay. And my second question was about the raw materials. We are seeing improvement in gross margins, and that has translated into EBITDA improvements as well. What has been the trend in raw materials, and is the Chinese dumping having a good effect on us and the industry? And also, have we passed on the correction in the raw material prices to the consumer?
To a large extent, the raw material input cost has been on a downward decline in the last 6 odd months. We have seen that, and that has been a benefit for us. We have kind of continuing to engage with our clients and discuss prices as per our normal policy every 6 to 12 months. We are continuing to do that, and whatever cost reductions or any pass-throughs we have been negotiating with the client. So that is no expectation of any sudden change in the outlook going forward.
Okay, sir. I understand. Thank you. Thank you for answering my questions.
Thank you. The next question is from the line of Rohan Advant from Prad Capital. Please go ahead.
Yeah, thanks for the opportunity. So my first question is on our margins in the flavor segment. They are in single digits, and they used to be higher earlier. So any roadmap for improvement in margins in the flavor segment, sir, and what are the levers that are available?
The flavor business also consists of different market segments. So we will look at our strategy and focus on the profitable segments of the market as we go forward. I don't have any further color on the strategy at this moment, and we will look at improving our margins and looking at the focus on the higher margin business going forward.
Okay. But, is there scope for meaningful margin expansion in the flavor segment over the medium term?
So the flavor segment has seen some margin expansion on the gross margin side. We have continued to expand our marketing and sales team to further enhance our growth. I think at this point, we will look at a longer term glide path. What is the businesses that we want to grow, which are the right kind of businesses to grow, and align the flavor strategy accordingly.
Got it. And sir, in the last call, you said that your revenue guidance is 10 to 12% for FY25. Now, with a strong quarter that we had and the order wins, you think we can better that in FY25?
I think I still remain committed to the 12% CAGR growth year-on-year for midterm 3 to 5 years. We have seen a big jump, comparable with last year, which was a muted quarter. So we will see that big jump in this period. Next year, we will be having a good base or a consistent base. So we will look at continuing more than 12% CAGR year-on-year.
Got it. And sir, lastly, if I look at the last few years, seasonally our March quarter is stronger than the December quarter. So is there anything specific to the F&F business that it is so?
Actually, what happens is there is a small part of the F&F business or a general kind of a consumption scenario which has it's a bit of a seasonality. It's not specific to product. In food, the seasonality is much bigger. But we do see that the sort of festival demand, as we call, when the last quarter the product is going in sales into the first or second quarter of the year, particularly in South India and the middle parts of the country, these festival seasons start coming in as soon as the kind of rain period, so July, August. So there is a uptick of demand in that first quarter for the FMCG in a way. And we see that always that the fourth quarter is stronger than the previous quarters, which is a normal trend. We have not had cannot pinpoint a very specific reason, but it is a normal trend that the fourth quarter is better, and then first quarter slightly drops, and second quarter onward it picks up again.
Got it. And this trend should play out this year also, right?
I don't think there is any difference to this trend. It should play out. I just want to highlight that as now most of our almost more than 50% of our business is linked to the export business. There, the trend is slightly different. Their seasonality is slightly different. But in general, we still see as of now, we still see the first quarter calendar, fourth quarter financial being the bigger of the quarters in the year.
Got it. Thank you and all the best, sir.
Thank you very much.
Thank you. The next question is from the line of Bhavya Sonawala from Samasa Capital. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yes, sir, you are audible.
Yeah. So I just wanted to know if it's possible to give a breakup of how much business comes from probably small players, SMEs, MNCs, and global players, if that's possible, and what was it probably 2-3 years ago, and how has it changed over the years, if that's possible to break down?
Yes, I think we have given that for the fragrance business in India earlier as well. We had roughly 20% of SME business in the past. It had come down to almost 10% in the 5 years. Last year it has stabilized, and this year it will probably be 12% of our overall fragrance business. The other categories remaining the same by and large. The mid and small have grown faster than the larger FMCG, and the global account, of course, is growing fast for us on a very small base. But the other categories have grown. So if I take a combination of the global and large accounts and the mid and small, the ratio remains the same. 45 with the large, 30% with the mid, and 10 to 12% with the small account. The remaining 10% is miscellaneous products to the industry, to other players, and export or ingredient business.
Okay, understood. Thank you so much.
Thank you. The next question is from the line of Dilip Sahu, an individual investor. Please go ahead.
Yeah, thanks for that. I basically wanted to understand the manufacturing assets spread across. We have in Europe 2 facilities. In India, we have facilities, and now we are starting up in Indonesia. All across, in China too, we had, I understand that one manufacturing asset which I guess we have sold. So what is the strategy of having smaller spread out manufacturing facility? Is it driven by the customer product, or is there any other reason we should having one singular, consolidated manufacturing asset?
No, so the products that we make are normally in the market. They are tailored product customized to each market, and they are best produced locally in the market and supplied locally for the lead time and efficient supply and customization of the product. Where we have the larger ingredient play, which is a sort of a global specialty chemical business, we have the bigger plant in India, which is servicing the global demands. So where it's a bit of the tailoring is done in each market locally, the cloth is made centrally in our large manufacturing site in India. So it's a bit of mixed of the requirements of the industry. And this is true for all industry players, that the final formulation needs to be close to the market. The bulk ingredients are produced globally in centralized economies of scale large plants.
Sure. Thanks. Just extending that question, we took around, say, 10 odd years and multiple acquisitions in Europe to get a foothold in Europe, and thankfully we are doing well. Is that same logic also applying to US? Do we have to have a design studio as well as manufacturing assets? Just as you rightly said, the demand of the market is to have localized manufacturing. So is that going to be same way in the US too?
To answer that question, answer is yes. We will need to put design studio manufacturing, all of the same steps that we took in Europe. Our approach to the US is more organic investment based. We are not looking at the moment for any inorganic acquisition. The US market is much more consolidated than the European market because you have basically one common market, unlike Europe, where the market is large, but each country and each region has its own language and own preferences. US has a very homogeneous market, so we believe that we can grow that market with our understanding of the market, develop that understanding and grow that market organically without needing to do any large inorganic acquisition. In addition, we have patented technologies and patented ingredients, which we are looking to sell in the US market, where we have the last few years of the patent protection.
Sure. Flavor business is around, we had a huge growth this quarter. Does it mean that the issues we had of overstocking in Middle East is over and 65-70 crore is the number that we'll see going forward?
So the issues were largely on exports. So I think the export is now more streamlined. Domestic growth has kicked in with certain segments of the food flavor business. As I mentioned earlier in the call, we are now at a stage where the business has grown to the next stage of strategy plan. We need to look at the next 3 to 5 years, which are the segments we want to continue to invest and grow. Certain parts of the business we may want to, look at a steady state or different strategies around ROC and the margins and which part of the business. So far we have not been very selective on the sectors within flavors where we are operating. We are taking business as it comes. Now we have a situation where we have built a size enough that with the next strategy, we will need to invest in CapEx, in capability, specific equipment, and we need to decide on which categories and sectors we want to focus and which categories and sectors we may want to look at as less strategic.
Sure. So if I go by the guidance of 12% revenue, 12 to 15% revenue growth, 12% for you, we have to add up another 250-300 crores to our top line next year. Since Europe is growing at 8-9%, which is a good growth and unlikely to grow faster than that, can we say that most of our growth will come from market share expansion in India and flavor growth? Is that a correct understanding?
I think we will see growth across the regions. At the moment, we are seeing growth in Europe. We are seeing growth in new markets. Ingredient business is reviving. Flavors is growing, and as well, India small sector is helping us to grow faster than the larger FMCG volume growths. So I'm seeing growth across all the sectors of our business. With the Southeast Asia factory being operational, I think that will give us another spurt of growth in Southeast Asia. Backward integration should give us good middle term 2 years horizon for global ingredient recovery, and both in terms of margin as well as revenue growth. So I think the basics for each part of the business have been put in. We will continue to monitor, continue to look at how to manage it more efficiently. And the growth momentum has been built in a sustainable, strong manner.
Sure. If I can ask one last question. You talked about 20% ROC if we reach around 12 to 15% additional volume of business. So which is essentially what will be by end of next year. So does it mean that 16 to 18%, which you usually say is the margin band, we'll be in the higher end of 18% margin band when we reach 2,400 crores of revenue?
So I think the profit percentage on sales may not change, but the capital intensity of the business, which is with large amount of inventory. So today, if I ballpark look, we are generating 120 crores of PAT for a full year extrapolated number on a ballpark 1,000 crores of total capital employed. So if we can reduce the capital employed by 100 crores of inventory, which is likely to happen in the coming year, and continue to grow 10% the top line, we will basically see a 140 or 150 level of PAT with a 900 odd crore of capital employed. So it's kind of 10% growth and a 10% inventory control, and we will be at the 20% which we want to be.
Great. Fantastic. And thanks for answering all my questions. Just the last one, if I may. The MNC deal you said will take up another 12 to 18 months to ramp up. From what I understand, there is multiple small orders that comprises of 300 crores. So why is the ramp up taking such a long time? Because you have already taken 1.5 years to get the deal. I thought all the back end, everything is in place. So is it a customer side issue why the ramp up is taking such a long time?
Yes. So the project was sort of in a redesign phase, and they had a revamp of the project a few months ago. So we have basically the kind of the timelines have been reset and project has moved ahead with a new starting point.
Okay, great. Thank you very much for answering all my questions.
Thank you.
Thank you. The next question is from the line of Jainam Gilani from Swan Investments. Please go ahead.
Hi, sir. Thanks for the follow-up. So when can we expect to come back to our peak margins of 18%?
I mean, we are thereabouts. A few tweaks, maybe a few of the bigger products going in quicker, and we should see excess of 16% margin. 18% in a good quarter we could reach 18%, but I think on an average longer term I would guide for 16.5, 16 EBITDA on sales as a consistent, sustainable way forward.
And so as you guided, can we expect ROC to be above 20% in the next 1 or 2 years?
Our target would be to bring it to around 20% and above on a sustainable basis in 4 to 5 quarters from now.
But say if we grow at 12% and if we have 16% margin, our ROC does not add up to 20%.
Because the capital base also has to be reduced by 10%, which is the inventory plan we have.
Okay, sir. That's it from my side. Thank you, sir, and all the best.
Thank you.
Thank you. The next question is from the line of Amarnath Bakat from Ministry of Finance. Please go ahead.
Just few questions left. One with respect to this pricing power. So just to understand, this raw material price fluctuates, either goes up and goes down. Are you in a position to pass on those raw material prices, either positive side or negative side? And if yes, what would be the time lag?
So normally we see a trend, and if there is a substantial increase or decrease, we negotiate and discuss with our clients on the same. Typical time gap between the let's say force majeure event or large price disruption or cost disruption to pass on is between 4 to 6 months. And we typically have contracts and stocks in hand to cover for this period. So we are not selling either ways through our, we are selling with our inventory in hand, which is a natural hedge for any fluctuation.
So it is in the context I'm asking, say, last few months or quarters, you might have observed the reduction in your raw material cost, which of course given you some extra EBITDA margin. So with that extra margin coming out of the reduction in the raw material cost will eventually be passed on to the customer?
So I think it depends on how the trend remains. We believe that the trend is sort of transient because general inflation across, across chemical, across as we see in the global markets is not coming down as fast. These are specific product related things which have come down and we have inventory. So at the moment we are bringing it down. We are averaging the holding costs. So we take advantage of lower prices. But these are, I think, transient because I am not 100% convinced that we are not, away from another disruption. There is a Chinese New Year, which the entire chemical business in China is closed. And with the disruptions in the kind of Red Sea shipping, there is further time lag and lead times and costs which are piling up. So I believe that the cost may stabilize and may slightly go up. So we are considering that before we go back to the clients with any corrections.
Thank you, sir. The purpose of this asking the question is because throughout the call we understood that there is a possibility of the margin improvement and maybe part of that will come from the gross margin because there is always a limit to increase the margin through the efficiency level. So what we have now understood from you that there could be a possibility from that gross margin side, but the majority of the margin expansion, projected margin expansion, would come from efficiency improvement as well as probably some pricing increase?
Yes. So just to give a little bit more longer term perspective on that, the gross margin last year we had a negative situation and we were below the average gross margin that our industry and we were enjoy for many years. So we are now in a situation which is more like the average gross margin realizations of the product mix. So there is no large jump upwards. We have just restored back to the historical average.
So can we assume the current gross margin level, what you achieved in the current quarter, will be more or less sustainable in the near future?
I expect so, unless there is any major disruption and some kind of force majeure event. In a normal course of business, these are sustainable gross margins.
Okay. If I may ask one last, regarding the current disruption which you see into this Red Sea related activities and probably the resulting increase in the transportation cost and the transportation time, and since you are exporting as well, are you feeling a kind of a small disruption at the moment, and what is your view on that? Is it going to impact your business anyway?
Not much because we talked earlier, most of the European side business is serviced to the European operation, Asia through Asia. So the transit times and this effect has been fairly small for us. But on the longer term, these things start to add up. Thank you, sir. Thank you very much.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you. I hope we've been able to answer all your questions satisfactorily. Should you need any further clarifications, would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call.
Thank you. On behalf of SH Kelkar and Company Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.